Hello, I'm JP from Singapore. After 22 years in the corporate world as a full-time working mom, I was laid off earlier this year. When I reviewed my finances, I realized I had already reached financial independence, enough to live comfortably without excess. So, I chose to retire early and live life on my own terms. This channel, Ikigai Living SG, is where I'll be sharing my journey from FIRE to Ikigai, living a life of freedom, purpose, and mindful living. In my earlier videos, I shared how I retired at 47 and also how I grow my CPF to 1 million by the same age. You can check those out after this video if you haven't already. Now, here's the challenge. Before turning 55, I don't have access to my CPF bank. That means my CPF savings are essentially locked up for another 8 years. So, to sustain my living expenses and my FIRE lifestyle, I had to rely on my liquid portfolio, which is my key focus today. This video is about how I plan to fund my lifestyle without active income and how I will manage risk in this decumulation stage. Here is a one-time snapshot of my financial net worth as at June this year, at the start of my Chubby FIRE journey. My portfolio is about more than $3 million as at June, and this includes all my liquid assets and my illiquid assets like CPF, SRS, and the cash portion of my insurance policies. And what is not included will be alternatives, investment property, as well as my home equity. Even my humble HDB is now valued at more than $1 million, although I have no plans to move out anytime soon. So within this, my current focus is on the liquid assets. And right now the breakdown within the liquid assets are stocks being 83%, funds made up 7%, cash made up the balance 10%. So since I'm no longer accumulating but now decumulating, my priority is to manage withdrawals and ensure that this is a sustainable portfolio. A common question is, how do you know when you have enough to FIRE or retire early? The Safe Withdrawal Rate concept, or SWR for short, helps us to answer this question. This is also where the famous 4% rule or 25x rule come in. Today, I will briefly discuss this 4% rule, what are the limitations, and what early retirees need to consider if you are adopting this concept. To apply this 25x rule, first you multiply your annual expenses by dividend 25. That will give you your target retirement portfolio or magic number. For example, if you need $40,000 annually in your spending, that means you need to have 1 million before you can retire. Put it another way, if we were to look at the withdrawal strategy, so you are able to withdraw 4% of your initial balance in year 1, and then adjust this amount for inflation each subsequent year. So for example, you have a 1 million portfolio, you are able to withdraw 40,000 for the first year, and if inflation is 3%, next year you can withdraw $41,200. This 4% rule is based off the Trinity study, which analyzed historical US data of a US portfolio made up of 60% stocks and 40% bonds. This study found that if you keep to this 4% withdrawal rate, you have a high probability of sustaining a 30-year retirement portfolio without depleting assets, based on the historical real market returns of 6 to 7% of this portfolio after inflation. If you look at the chart, based on a 4% rule for somebody holding a US portfolio and looking at a 30-year horizon of retirement, this portfolio will have a success rate of 95%. For early retirees looking at a longer 40-year retirement period, this portfolio is also pretty good, giving us a success rate of 80%. In subsequent years, a researcher by the name of Wade Pfau extended the research to determine the success rate of a retirement portfolio made up of 60% global equities and 40% global bonds. His findings revealed what is called the US exceptionalism, whereby the US market historically is able to deliver exceptional returns which are not representative of global markets. For the global portfolio, using the 4% rule, it will only be successful 60% of the time over a 30-year retirement period. If you were to extend the period to 40 years, the success rate dropped even further to 53%. However, if you lower the withdrawal rate to 3%, the global portfolio has close to 90% success rate over both 30-year and 40-year periods. So, for somebody who's on their FIRE journey or planning for early retirement, 30 years horizon is clearly not enough. We need to plan for a retirement period of 40 or even 60 years. And a longer retirement period basically means we need to adopt a lower withdrawal rate to increase our rate of success. That is to enable us to protect against market volatility and sequence of returns risk. So, in conclusion, for somebody who is doing early retirement or on their FIRE journey like myself, 3% seems to be a sweet spot where we can have significantly higher confidence levels globally. Also, I think if we remain flexible in our withdrawal strategy and willing to adjust our spending during market downturns, that will also increase our success rate. So, in conclusion, I'll be using actually the 3% safe withdrawal rate, since that actually is giving me a much higher success rate. In managing my early retirement without active income, there are actually 3 key considerations. First, I need to consider my cash flow and withdrawal strategy. As explained, I'll be adopting the 3% withdrawal rate, with flexibility to adjust my spending based on market conditions. I will also supplement withdrawals with dividend and interest income. Secondly, I will need to manage sequence of returns risk. This is the danger of poor returns early in retirement that will permanently hurt the portfolio sustainability. To mitigate this, I'll be keeping a cash bucket of about 2 years of expenses, so I do not need to sell assets during downturns. I also plan to keep a war chest mainly made up of US dollar to take advantage of market opportunities. Third, I'll be also looking at my asset allocation and risk balance, since I'm now shifting from pure accumulation to preservation while maintaining growth potential. I will be reducing concentrated positions in favor of broader diversification. So, in funding my retirement, I'll be using what I call a total return approach, which is where I treat the whole portfolio as a whole and combine capital gains, dividends, interest, etc. to fund my lifestyle. So you may ask, why don't I consider investing in a 100% dividend portfolio? So based off my 3 million net worth, for example, if I invest in the portfolio of REITs or dividend yielding stocks giving 5%, I can actually safely have a passive income of 150,000 a year, which will equate to about 12,500 a month to spend without drawing down my capital. However, I do not actually like this approach because this overall portfolio will lack growth, and I do have quite a long retirement horizon. And also dividends could be cut in bad years, and there's also a risk of investing in riskier assets, and that is why they are able to give a higher yield. On the other hand, if I were to base it off a 3% withdrawal rate and looking at the portfolio of 3 million, I can actually safely withdraw 90,000 a year, which equates to 7,500 a month. And this is actually much higher than the CPF ERS payout of 3,300 at age 65. And cash flows would be then funded from a mixture of dividends, interest, bond coupons, capital gains realization when I take profits, or even option trading income, which I'm also doing. And also there's also further buffer because my actual expenses this year will be actually less than 80,000, and I foresee next year when I no longer need to pay income tax, that will actually drop to 70,000. I will also be actively managing my cash bucket, which serve 2 main purposes. 1, to meet my liquidity needs, and 2, to act as my war chest for market opportunities. I will have an active cash management strategy. To cover my liquidity needs, I will have a Sing Dollar fund, which will cover 1 to 2 years of my expenditure, and Singapore dividends and interest income will also help supplement my cash flow. This will help to prevent forced selling during market downturns. I also plan to have a US opportunity fund to take advantage of market opportunities. That will also support me doing option trading to generate additional income. Now, let us take a look at some examples on how I will implement this total return strategy. In a normal year, as I said, I'll be spending 90,000. And for example, if I were to have 30,000 coming in from dividends and interest that year, I will have to generate another 60,000 from option trading, capital gains, etc. in order to replenish this liquidity needs portion and refill up the bucket for the liquidity needs. In a bull market, I will still be spending 90,000 and still having 30,000 coming in from dividends and interest. But I may be doing more selling off and taking profits and enjoying capital gains of 110,000, for example. That means total inflow is 140,000. So to replenish my cash bucket, 90,000 will go back to refill the liquidity needs, while additional 50,000 will flow to beef up my war chest. On the other hand, in a bear market, I will still spend 90,000 a year, but dividends and interest could be cut to 25,000. I could generate another 15,000 from option trading. Total inflows is only 40,000 because I will not be actually selling any shares during the market downturn. So, liquidity needs portion will decrease by 50,000 and will not be fully replenished. War chests will also be more actively deployed to take advantage of the bear market, or can also partly replenish the liquidity needs part. I hope that gives you a clearer picture of how my total return approach will work. So, since I started my FIRE journey in April until now, for the past 3 months, here is what I've done in terms of portfolio actions. First, I increased the portion in Singapore investments. I increased my allocation to dividend-paying stocks and REITs in order to enjoy a greater portion coming from dividend income. Secondly, I've also started investing in a small portion in bond funds to also enjoy bond coupons to fund my lifestyle. Third, I diversified my equity holdings, reducing concentrated stock position to lower individual company risk. Overall, however, I still maintain a major allocation to growth stocks as I still want to go for long-term wealth building. So, how did my stock portfolio perform in the first half this year? To recap, I retired just before April Liberation Day tariffs and the subsequent surge in market volatility. Without active income, this was the first time I truly missed having a paycheck to buy into the dips. Still, I had a small retrenchment package which I cautiously deployed back into the market during this period. I also used this chance to rebalance, diversify, and improve the quality of my holdings, while always making sure my liquidity needs were not at risk. There were 2 major events that happened in second quarter. First is when Trump announced Liberation Day tariffs when global stocks fell. And the second event is when he declared to the world that this is a great time to buy. The next morning, I woke up to the biggest daily portfolio change of almost $125,000. Overall, in the second quarter, despite no active income, because of the market opportunities and the actions I took, I managed to generate a portfolio return of 4.5%. Overall, in the first half, the portfolio generated a total return of 7.9%, and this compares with the S&P 500 index return of 4.6% and the STI index return of 4.9%. I'm just taking into account the share price movements of the indices without factoring in dividends. In terms of what I own in the stock portfolio, which accounts for 83% of my whole liquid portfolio, right now in June I have 30 counters. And in terms of region, 37% of the positions are invested in Singapore stocks, while the balance 63% is invested in US stocks. In terms of sector breakdown, my largest exposure is in the technology sector, accounting for 38% of my position, followed by the financial sector, 19%, and these are mainly Singapore banks. That's subsequently followed by the other sectors as shown in the chart. So in a nutshell, this is my FIRE plan on how I'm going to manage my liquid portfolio to fund my Chubby FIRE lifestyle and keep it sustainable. My approach aims to balance income generation, investing in a mix of dividend stocks, bonds and REITs, together with growth allocation, as I still aim to grow my portfolio value over time. At any point in time, I will also have a safety buffer made up of 1 to 2 years of cash reserves that will help protect against the need to sell assets during market downturns. If you are already retired or on your own FIRE journey, I would love to hear from you. How are you managing your portfolio for both income and sustainability? Share your approach in the comments below. And stay tuned. In my future videos, I'll be sharing my money habits, savings rate, lifestyle choices, investment strategies that allowed me to build up these assets and achieve Chubby FIRE at 47. So hit like and subscribe so you will know when I next release my video. Thanks for watching, and I hope this video has been useful to you. If so, I will greatly appreciate if you can give it a like and subscribe to my new channel for future updates. Till then, have a great Ikigai day.